Good morning, everyone, and a very warm welcome to the Shelze Fiscal webinar series. My name is David Oparinde, a tax associate at Shelze Professional Services, and I will be your moderator today. So whether this is your first session or you've been with us from the very start of this webinar series, thank you for giving us your Tuesday morning. So a few housekeeping notes before we begin. Your microphones are muted and will stay muted throughout. This helps keep the audio clean for everyone. If you have a question at any point during the course of the webinar, you can type it into the Q&A panel. Do not wait until the end because we curate the questions as they arrive. We're going to have a dedicated Q&A segment just after 12. And also we are recording, and every registered attendee would receive the recording and a withholding quick reference card within 24 hours. And there are going to be two short polls during the session. When they appear, please vote as your votes are anonymous. The results will genuinely shape how the speakers handle the rest of the session. And so today's topic, it touches every single organization that is represented on this call. Withholding tax under the Nigerian Tax Act 2025. So if your organization pays contractors, consultants, landlords, suppliers, or service providers, and of course, every organization does one or all of these, this new act has changed your obligations. And so to set the stage, it is my pleasure to welcome the managing partner of Shelze Professional Services, Mr. David Apafu.
All right. Thank you very much, David. It's good to be here. Good morning, everyone. I'd like to, start by saying that, withholding tax is a part of Nigerian tax system where a lot of professionals, seem to find a lot of comfort. And why do I say that? Is because, most times some of these deductions have already been programmed into our various systems. The rates have pretty much been the same for quite a while, except a few changes, intermittently. And most times when people don't even know what to do, they just apply a flat 5%. And so that's, legacy memory is what still runs a lot of finance teams. And for those that are automated, some of those legacy rates are still, running those systems. And, the rates that have been memorized long ago have really changed. The deduction systems that, we've automated into our systems need to be modified, right? And that's because, with all the changes that are going on, very few people have looked at the underlying logic to say what sort of transactions, come under the withholding tax ambit and still look at the same rates, right? And that's because there's really been a lot of consistency around withholding taxes for a while. But the Nigerian Tax Act has really changed all that. So as much as, things like the VAT took a lot of center stage, the CIT, the changes around the rates, new development levies, withholding tax has not really taken as much center stage as we would expect it to take. Even though, the withholding tax regulations came out, I'll say, about a year before the full Nigerian Tax Act, right? But it hasn't taken the kind of center stage that it is supposed to take. And this new framework basically has expanded the scope, bringing in new multiple categories that, were previously untouched and bringing those transactions into the net and into the scope of withholding tax. And there are new obligations for different parties, the party deducting and the party suffering the deductions. And there are also obligations around cross-border payments that did not exist before. And so there's something that you're going to be hearing, and I really want to have that as a takeaway from today's session, right? So it's not really about what rate applies, right? It's more of a question around your system and your architecture, right? So it is whether your entire withholding tax architecture, right, still works under the new act. The rates are the easy part, right? So things around the architecture, your scope, the timing, the documentation, the credit recovery are where the real exposure when it comes to an audit really hides. And so to take you through all this, Iyanu Machanogbe, who is a tax associate with Shelze Professional Services, and has led a lot of withholding tax advisory work for our clients across multiple sectors. Will take us through the NTA 2025 transition. He has seen what businesses get right and he has seen what they get wrong at the same time, and has also defended a number of these clients when it comes to audits. Ian, the floor is yours. Please go ahead.
All right, thank you, sir. So indeed, the architecture has changed. And then, as Mr. David has rightly said, you need someone who has been inside the new framework from day one to walk you through it. So Iyanu Oluwa Majanobe is a chartered accountant and a chartered tax practitioner, and he is the senior tax associate here at Shelze Professional Services. He has led withholding advisory engagement across our client portfolio through the entire NTA 2025 transition, from the recalibration of the withholding rates to restructuring advice to NRS audit defense. If there is a withholding question from the new act, Iyanu has already answered it for the clients. So Iyanu, welcome as you take us through the 3 pillars on the withholding tax.
Thank you, David. Good morning, everyone. Hope you all are having a great day. Today, we'll be going through 3 pillars, right? And I promise you, by the time we are done with this section, in fact, by the time we are done with the first pillar, you already have a lot of things to go back to when you get to your text, right? So let's start with what has changed. Let's start with what has changed, the Withholding Tax Act. Let's start with those who are obligated to withhold. And then by the time we are done, you see that even the rates under the old regime, withholding taxes embedded in so many separate taxes, right? We have them under Company Income Tax Act, we have them under Personal Income Tax Act, we have them under PPT, Petroleum Profit Tax Act, and all of those things, right? So if you want to get maybe what the tax law says about a particular transaction you're withholding, you find out that you need to go through all these things, and start checking for different laws. You might need a particular transaction, you might need a particular law, and then you start going around different tax acts, right? So that is what it was during the old regime. Another notable mention is the ordinary course of business, right? So for ordinary course of business, what ordinary course of business means is a normal routine, for day-to-day activity of a company, but this ordinary course of business has been a major challenge from time immemorial. You find out that the definition, because the act didn't simply define what ordinary course of business means, we have so many different interpretations, and then you discover that over the years you have several disputes going on as regards the particular transactions. You find different conflicting FIRS interpretations, and then different tribunal decisions, and which has always been a pain in the neck most taxpayers. And then you discover that to be conservative, taxpayers would just ordinarily withhold for a transaction that should ordinarily pass as ordinary course of business. They want to save themselves the hassle of going back and forth with NRS officials. And then so let me go to what the new law says. So speaking about the new law, so the first thing I mentioned was during the old regime, we have several tax acts, right, where you can get withholding provisions for. But this new law now has simplified it, right? So we have the Nigerian Tax Act, we have the Nigerian Tax Administration Act, and of course, the Withholding Regulations 2024. So anything withholding that you need to check on, you need to check the rates, you need to check if a transaction qualifies for withholding taxes. You don't need to go to any of all these 3 laws, and then you get anything that you're looking for there, right? So notable mention again is the tax ID penalty, right? For suppliers who don't have tax IDs on their invoice, you don't that it should have. Right. Another notable mention is across the counter transaction, right? So across the counter has come there to replace ordinary course of business. I said earlier, ordinary course of business has really been an bottleneck, right? So across the counter is defined in the Act, right? The Act defines it as any transaction carried out between parties without any established contractual relationship, right? So either prior formal contracting arrangements, and then it means that payments must be made instantly in cash or via electronic means. So what this means is that if you read the definition, there are 3 conditions that must be met to classify as across-the-counter transaction. You see, some people will even call it over-the-counter transaction, right? So the 3 conditions that must be met. The first one is no established contractual relationship between both parties, between you and the supplier, or you and the buyer, The second one is there must not be a contractual agreement, no contract agreement should be involved, and the last one is payment must be made instantly. You go, you purchase anything that you want to purchase, and then you pay instantly, or you do a transfer, you settle your payment via electronic means. What this means is that if you have a standing purchase order, from a supplier, what this means is that this will not qualify as across-the-counter transaction. Or you have a credit purchase from a supplier, because you are not paying instantly, it can't qualify as across-the-counter transaction. So basically, this new act what this new act has done is to simplify the taxes, define, remove the ambiguous definition of across-the-counter ordinary course of business, and then put the definitions across the counter transaction, and then also again to curb tax evasion and then ensure compliance. So I'm sure you would agree with me that a new tax law is the right step and in the right direction. So let's take a look at the rates. So we have active services categories. Here we have the rates, and then which is classified into 4. So the first one is resident corporate. The second classification is resident non-corporate, and then we have non-resident corporate and non-resident non-corporate. So basically, you would notice that in all these rates for non-resident companies, you'd notice that the withholding tax rate is double. The whole idea is to ensure that the double rate will serve as the final tax for all these companies, because these companies are probably not taxed in Nigeria. It saves the NRS guys the hassle of going after companies that you cannot chase. You'd notice that we have construction, which is 2%, and then we have other constructions, which is 5%. Right? It's important to know the difference between these two. Right? So for construction, it's divided into 2 tiers. Right? So the first one is for road, bridge, buildings, power plants, all those kind of construction. Right? And you notice that the withholding rate for these guys is 2%. So what as against the old law, before it used to be 5%, but now it has been reduced to 2%. I mean, this is a great development, and the whole idea is to reflect the low margin reality of all these infrastructural projects. You know, same thing for manufacturing, same thing for supply of goods. You see, supply of goods before now used to be 5%, but now it's 2%. You know, also to reflect the low margin turnover of all these companies. All right, and then we have sectors that are exempt from withholding taxes, like the guys in the oil and gas sector. Right, so petroleum products is fully exempt. So the supply of diesel, you purchase fuel, gas, you know, all those things, any energy consumption that you have done, it's exempt from withholding. All right. So let's check the next read. Here we look about we take a look at residents versus non-residents, right? And then we look at the different rates that we have. Like, so we have commission for residents it's 5%, and for non-residents it's 10%. So it's double the rate of residents, which would serve as final tax for the non-residents. For constructions, like I said earlier, there's two different types of constructions. So construction for road, bridges, and projects is 2%, and then for non-residents, it's 5%. Other construction is 5%, non-resident is 10%, you know, and then we have other services and the likes. So another thing to note again is to be able to distinguish between professional services and other services, right? Because in practice, people usually mistake the two for each other, right? So professional services should include maybe your accounting fees, you know, accounting services, tax services, advisory, you know, legal services, even engineering services, right? Those are what you classify as professional services and not other services. So it's important to note that to be able to get the right category of all these transactions, so you don't deduct the wrong withholding rate, right? So, and then you notice that for non-residents, like I said earlier, it has a higher percentage. You know, the whole idea is to make the tax final. You know, so it means that they are not liable to further tax in Nigeria. You know, and then the only exemption is if the non-resident company has in Nigeria, they are still exposed to income tax, right? There is also a case where a non-resident is resident in a country where there's a double taxation treaty with Nigeria. You know, so in that case, you shall apply the rates that is specific to the treaty country. You know, what this means is that as an withholding agent, you must be able to determine if a non-resident company is resident in a country where they have double treaty with Nigeria, you know, and then you must be able to apply the appropriate rates for these companies. So basically, when you are trying to review your account or when you are involved in transactions with non-residents, the key things to note in this kind of transaction is that you review all your non-resident payment contracts, you verify their treaty status, obtain their certificate of residence before applying the treaty rates. So it means before you deduct, you ensure that you obtain the certificate of residence or any document that can state that or that can show that these guys are residents from a treaty company. Let's take a look at the passive income category. So for all passive incomes, right, they have a flat rate, right? And then unlike other transactions where a company or an individual does not have tax ID, where you have to use double the rates, for passive income, you use the actual rates, right? So examples include dividend, interest, royalty, rent, entertainment, and lottery, right? So all these things are classified as passive income. So in the case where the company does not have tax ID, so you don't need to double the rates. The way the law says, oh, if you are doing a transaction with the company without PID, you should double the rate of the withholding, right? So, but if it's a passive income, you don't double the rates, right? So for interest, there are also exemptions for interest, right? So exemption for interest is bank interest by way of direct debit. If the account is domiciled with that particular bank, and then the interest payment is by way of direct debit, it means the transaction is exempt from withholding. So a notable mention in this schedule is the lottery and gaming and transaction. So before now, the people who play lotteries, people who play all these gaming bets, their proceeds are not usually charged, are not usually exposed to withholdings. But this new law now captures, it has expanded the scope and has now captured lottery and then gaming winnings. So if you have a company who operates in this line, so what it means is that winnings of your customers, you should withhold, right, before you pay them that winnings, right? And then the applicable rate is involved. So other items are accepted for withholdings. We have, like I mentioned earlier, the bank interest by way of direct debit. So we also have transactions that in the financial institution, transactions like telephone airtime, data, all those things are now exempt. Same thing too for oil and gas supply. These guys are now exempt also. And of course, across the counter transactions, they are classified as they are now exempt from withholding. So part of the people who are also exempted from withholding are small companies. So this new act has increased the threshold for small companies. And when people ask you what is a small company, right, it's simple, right? So for small companies, for you to be categorized as a small company, then it means that your gross turnover is either 100 million or less, and your fixed asset is 250 million or less. Conditions must be met. It can't be either of the two, right? So for you to classify as a small company, you have to meet these two conditions. Again, there's also like a trap for professional services, right? The Act has clearly stated that any business providing professional services would not be classified as a small company. So what this means is that if you're an accounting firm, a tax firm, if you're a legal firm, or engineering, you are in the category of professional services, you cannot claim exemption for withholding. You can't classify yourself as a small company, irrespective of your turnover, irrespective of your asset size, right? And then this is like a common trick that some people don't know yet, right? And then there's again another exemptions, another clause for small companies, right? So for a small company to be able to be exempt from withholding fully, right, it means they have to consider two terms, two conditions. So the first one is the supplier must have a valid thing, and the second one is the transaction value should not exceed 2 million naira in a month. So as a small company, even though your annual gross turnover is 100 million or below, you must have a valid thing, and your particular transaction should not exceed 2 million naira in that month. If it exceeds or if it does, then you are liable to withholding. So let's go to the common errors that people make. And I see that this is, we usually see this in practice. The first one is wrong category mapping. So like I mentioned earlier, you mistake professional services for other services. You interchange the rates. So instead of construction, you had used other construction. These rates are different, right? And then if you are unable to be able to know the right category, there's already a risk involved. This is a system error. So what it means is that you should be able to identify what this particular transaction is and which category it falls under. Right. The second one is the stale system table. Right. You find out that some people still have the old laws on their ARP systems. Right. Up until now, it has not been updated. Right. So it's, what this is. So in this case, right, and the case where this new law has even reduced rate of most of all these withholding taxes, it means that you are now overpaying, because you have been withholding excess amounts, especially for transactions that the rate has been reduced, right? So it also means that you need to update your ARP systems so you can tailor it to the current rates based on the new law, and then the last one, which is really, really common, is the gross and net confusion. So people up until now still don't really know where to deduct the withholding from. Either is it the net, is it the gross amount, but it's clear, right? The law is clear. You deduct withholding from the gross amount, not the net amount. If you're deducting from the net amount, it means you're under remitting, and then the withholding tax that you've under remitted is exposed to interest and penalty. Then by the time you calculate interest and penalty on unremitted withholding amounts, you'll be shocked that even the penalty and interest might be more than the principal amount, which serves as a compliance risk. Right. So I'm sure that if I ask most of the people here, they already encountered any of all these things, that I've mentioned. So if you want to ask, I would ask people, which of all these changes, which of all these withholding changes have affected any of your payments, maybe in the last 30 days, right? So were you compliant? Were you able to detect? Is it something you already know? But we have a pool that David would take us through.
Thank you very much, Yanu, for building up our knowledge on that first pillar that has covered the new rates, the expanded scope, as well as the common errors that we see in practice. So we want to check the room, as Yanu has mentioned, and I am launching our first poll now, which you should see on your screen at the moment. So the question says, as the organization completed its withholding rate schedule for the NTA 2025, first option says yes, second one says partially, the third one says not yet, fourth one says not sure. So we'll be allowing 90 seconds for us to punch in our answers. And please be reminded that your responses are anonymous, so you can punch in your answers. Okay, we still have a couple of people here to turn in their answers. There are no wrong answers here. I mean, what we're interested in is where the room stands collectively, because it's going to tell us how much of Pillar 2 we need to emphasize on. All right, so from the results, I mean, we can see that we are a well-prepared audience, as a bunch of us have already fully updated and verified with the new withholding rates. And Pillar 2 is going to pressure test this our confidence, because the structural changes, they actually go deeper than what we see on the rate table. So Yanu, walk us through Pillar 2.
All right, thank you, David. I'm seeing an interesting response here. So let's look at who must be told. Let's look at who are the obligated people that that must be told, right? So the Act has stated clearly 6 categories of people that are required to deduct taxes at source. So the first one is body corporate or unincorporated. So, and then there's a bracket other than an individual, right? So this is clear. This settles it, right? If you're an individual, then you're exempt from withholding tax, right? The second one is government ministries, departments, and other agencies. We have statutory bodies or public authorities. We have any institution, organization, or enterprise, including tax-exempt entities. So these tax-exempt entities they include churches, they include embassies, they include charity organizations. These guys are exempt from income tax, right? But irrespective of that, right, if they are involved in a transaction that qualifies for withholding, then they are expected to withhold tax, right, irrespective of the fact that they are exempt from tax, right? And then we have payment agents, representing any of all these guys above. So payment agents can be intermediaries. They can be maybe a fintech company that's making payment on behalf of your company. So if that's the case, then payment agents are responsible for withholding taxes. And of course, we have public authorities. So there's all that thing to note again. So in case of individual, right, it has always come up over the years that, okay, as a sole proprietor can be classified as an individual, right? Sole proprietors also are expected to withhold. So the answer is this, right? If you're a sole proprietor, and then you are carrying on a business enterprise, if you are doing a transaction as your business enterprise, then you are expected to withhold. If this transaction is being carried under your registered business name, then you're expected to withhold, right? So we also have cases where they are, especially maybe in a group company, there's a shared cost. The cost setter that is responsible for making that payment is also responsible for withholding taxes. If it's a group company that is paying on behalf of the subsidiary, then it means the group company is supposed to withhold. All right, so the law is clear on that. So if you have any third party, or you tell any third party to make any payment for you, then the authorized person making that payment gets the deduction, right? It gets the deduction obligation. The person is expected to withhold taxes at that point in time. So let's look at some timing difference for withholding taxes. So in practice, right, the general rule for withholding tax, people ask, okay, so I've done a particular transaction. At one point, do I withhold? At one point, does withholding tax becomes liable? So the general rule is straightforward, right? It's the earlier of when the payment is made or when the amount has been settled. So it means that if I do a transaction with someone, it can be on credit, and I don't make payment until after 2 days, so it depends on when I settle that transaction. So if when the transaction has been settled or when the payment has been made, earlier of the two it's the general rule, but there's a difference for related party, right? So for related party, the rule is a bit stricter for related party. I mean, this is done too because companies usually use loopholes of the tax law to take advantage of it, So for related party, right, it is earlier of when deduction has been made, or when payment has been made, or when the liability has been recognized. So what this means is that if I do a transaction with a related party, if I recognize that transaction in my books, then it's liable to withholding, irrespective of whether I've settled the liability or not. So if whichever one comes first, the payment date, or when the liability is recognized. For example, right? So if company A receives services from company B, and both of them are related, they receive service from company B on 2nd of January, but recognizes liability on that day and pays on 1st of February. What this means is that withholding obligation would arise on 2nd of January. Like I said, the whole idea of this thing is to stop tax evasion. You notice that companies, especially good companies who do business with related parties, they can decide to not pay the liability, and it goes on their books for years. It goes to the next year, it goes to the next, it goes to the next period. Transactions are going on, but payment are not being made. Nobody's chasing who, but withholding taxes. So that's the kind of thing that the law has tried to curb. So the whole idea, the period recognition for this is that, for a related party, right, you should be able to, so you should know, you already know that, okay, when liability has been recognized, you've already triggered withholding taxes, that liability, even before the cash movement, right? So it is very important that from time to time you review your intercompany agreements, intercompany accounting policies, in the sense that don't forget that if you do a transaction with a related party, right, irrespective of how much you put there, the NRS will still come and then do their audits. Even though you are deducted withholding from that particular transaction, if they come and see that, oh, this transaction has not been its arm's length, the transaction was not done with the current market value, and then the amount has been reduced, it means that you've overpaid withholding for that particular transaction. And then once you've overpaid, it creates a permanent cost. Okay, so it's very important, that you are able to follow your transfer pricing agreement, because it creates a potential risk for related party transactions. And then let's look at other things that this new tax has also included. So like I said earlier, so we've expanded the scope of this new tax. So right now we now have barter agreements, we have stock transfer, all these things. If you settle your debt or you settle your liability without cash, you can have an agreement with someone that, okay, what do you have? Let me give you what I have to settle this this liability. What this means is that you've settled your liability. How then do you pay the withholding when cash is not involved? Okay, so these are one of the scopes that the new tax has included. So for barter, right? If you engage in a barter agreement with someone, so the dates where the barter occurred, the dates where the barter exchange occurred would be when the withholding tax is due. So, and then who, if you ask me, who pays for this, who is obligated to withhold in the case of a barter, is the person giving that barter that is expected to withhold. Let's not forget that even though there's no cash transfer or there's no cash movement between these two parties, what you're expected to do is you're expected to get the market value or the market rate of that particular transaction, and then you remit to the relevant tax authority. Same thing goes to for stock transfer. So if you do stock transfer, the dates where the transfer occurs would be when to deduct. and then the person transferring the shares, is the person liable to pay the withholding. So again, same thing goes for debt swaps and all those things. Another notable mention for in this new act is the inclusion of this digital economy. For companies who have a significant economic presence in Nigeria, right? So when a company has significant economic presence in Nigeria, what the law says is that. So let me give you an example now. So companies that transmit signals in Nigeria, they have data in Nigeria, they have like a connection with Nigerian's e-commerce. You have an app store in Nigeria, you have an online gaming site in Nigeria, search engines in Nigeria. So examples can be maybe Google, Facebook. They might not really have physical presence in Nigeria, but they have significant economic presence in Nigeria. So the withholding tax has again captured these people to the tax net. And then if you're doing a transaction with these people, you should also consider this withholding rate. And then when you're having a transaction with them, the withholding rate should be double of what the actual withholding would have been for a resident company. And that will serve as a final tax for these guys. Let's look at things that can cause audit triggers. So the parts where NRS are usually interested in. See, so the high risk categories are the net of tax contracts. So the net of tax contracts is where a taxpayer pays withholding, on net of tax. So example is the amount might be 10 million naira. Your supplier can tell you, oh, this is how much I want in my account, net of taxes. The agreement is net of taxes, you pay me this amount. So what this means is that the payer, if the payer agrees to it, it means the payer is responsible for the withholding, and it means that the payer will bear the cost of that withholding item. And then let's not forget again, if you are paying the taxes of another company, that particular transaction or expense will not be allowed for tax purposes. It will not be allowed for when computing your income tax, will not be allowed as tax deductions. So another high risk area is related party transactions. So for related party transactions without formal transfer pricing agreement, without the master file, and then you do transactions with each other, NRS can come and tell you, oh, these transactions are not at arm's length, they are not at market rate. So all these things can create a risk area for the company. Another one is for professional services firm. I mentioned earlier, if you're a professional service, you do not qualify as a small business. So it means that if you are, before now, saying, oh, my threshold is not up to 100 million, right? I'm still a small company. I've not gotten to that threshold, right? It's right time you face reality, right? You cannot claim exemption for withholding, right? And then we have penalties for non-compliance, right? So the penalty for non-compliance for NRS, when you fail to deduct, is 10% of administration fee of the undeducted tax. And then if you are deducted but fail to remit, it's 10% per annum, and then interest rates based on the current CBN monetary policy rate. Same thing goes for state internal revenue services. If you fail to deduct, it's 10% of the undeducted tax. And then if you are deducted and fail to remit, same thing applies to for that, a 10% penalty rate, and then interest will be at the prevailing rate of from CBN. And then for defaulters, for ministries and then government agencies, the Accountant General has the right, he has the power to deduct taxes from their accounts, from their allocations. So that's, for that one is clear. So let's go through the remittance. Let's see deadlines for remittance, how these returns are done, and then the things that are needed. So these are very important things that we need to note, right? Because you notice that people entertain them for each other, and it's important that you update these rates in your ERP systems. So deadline for filing withholding to NRS is 21st of the following month when the transaction occurred. So deadline for filing state internal revenue service for capital gain tax and payee is 10th of the following month. And then withholding for state internal revenue service should be 30th of the following month. So these deadlines can be like a compliance trap because people can entertain them for each other, and it might be difficult for some people to track all these dates on their calendar, so it would be nice if you have a functioning ERP system where you can configure all these dates on your ERP, and then before the deadline or before the due date, it can flag these particular transactions. So for the returns and regulations, when you want to file, so where you want to file, you submit your returns with the remittance evidence. So when you're submitting your returns with remittance evidence, it must have the beneficiary name, it must have the address, it must have the tax ID, the nature of transaction, the gross amount, tax deducted, and the particular transaction, the month of transaction where you occurred. And then when you deduct and remit, right, you must also issue receipts to the beneficiary. It's very important that the beneficiary gets their receipts so they can also use it as proof of tax credits. They can use this credit to offset their own income tax, whenever they want to file their own returns too. There's again the protection for these beneficiaries in the case where they were not issued with this withholding receipts, right? So the tax authority would also still grant them this relief, irrespective of whether they got their receipts from the withholding agents or not. Let's look at the credit notes, how to obtain your credit notes, and then how to utilize all of these credits. We're talking about the withholding tax. We're talking about withholding. So let's look at how you can utilize this withholding. So there are steps for obtaining your credit. There are steps for obtaining your credit note. So the first step is you deduct withholding tax at source. Second step is, so when you deduct, you remit, then you credit the receipts issued. When you've credited, the beneficiary claims credits, and then the third stage is offsetting your CIT with the withholding credit that you've gotten. So there's like a first step. So the first step is withholding and then remitting. You as a beneficiary, you claim, you get receipts
Can we hear me? All right, so we apologize for that breaking transmission.
Thank you, David. I think I'm back. So to close this note, right? To utilize your credit notes, right? Because people usually ask, what if I'm not able to utilize all these credits? Right? I'm not able to utilize all this credit. You can roll over credit that not be utilized the next period and carry it forward to the next period. But what this means is that you have documents with all these things. All of your documents must equal and genuine so you can claim to do. So let's look at where you're talking about documents. Let's look at the documentations that involved all of these things. Right. Okay. For the documentations that are involved, right? So what's usually what they ask for is they ask for your withholding receipts, right? NIS asks for your withholding schedule. They ask for your remittances. They ask for the particular transaction. They want to see invoices that relates to this withholding schedule that you've done. They want to see all these things. So when you are all right. So the documents are needed to build your file before audit. So when you are preparing for audits, like I said earlier, you need to get your withholding tax registrar. So that registrar would have all of the details of the beneficiary that you deducted your taxes from, to have the gross amount, to have taxes that you've deducted, and then again, you also have to show proof of remittances, right? You have to show them the invoice that you've gotten from your supplier, and you have to show them proof of remittances of all of these withholding taxes that you've deducted. You also need to show them receipts that you've issued to these beneficiaries, and then most importantly, you have to ensure that all your suppliers have tax IDs. It's recommended that you verify tax IDs of all your supplier. It's even easy these days now. You can just go online to the NRS website to verify that to verify a particular tax ID. So it's not as difficult as it used to be before.
All right. Thank you, Yadne. Thank you for running us through the second pillar. I mean, we've built up our knowledge on the documents that are required. We've built up our knowledge as well on the triggers when withholding actually falls due. And so it is time for our second poll, which you should be seeing on your screen at the moment. And the question says, how would you rate your organization's withholding compliance exposure under the NTA 2025? So there are 4 options. First one says low. Second one says medium. The third option says high. And the last option says unknown. So we have 90 seconds as always to fill in our answers, and we can be honest with this one because nobody's going to see your individual answer. What we're going to see is just the aggregate, and that aggregate is going to be instructive for us to know what is obtainable at the moment. Okay, nice. So we have an interesting split of results. We have 19% that says that your exposure is low. We have the bulk of 46% saying that the exposure is really 15% high exposure, 20% unrestricted the exposure at the moment. So, yeah, before you move into that, can you, in 30 seconds, let us know what this tell you?
Okay, this is an interesting result because almost half of the people here in this poll are either exposed, or they've not been assessed. You can see that there are for 3% who said the gaps are known, but they are still on their list. I mean, this just shows why we are doing this webinar. It's just to enlighten us, and then broaden our knowledge on all these tax matters. So if I'll go to the third pillar, and then I'll just show you where the money is, particular transaction where the money is. So let's go to the supplier cash flow position. Can we go to the next slide, please? So yeah, so the whole idea of withholding is that withholding is an advanced form of tax, right? But it's an issue for some companies too because because of the time value of money for them, so withholding tax now creates a working capital gap for some companies, right? So ordinarily, you have done a transaction for 10 million, and instead of receiving that full amount, you are getting maybe 9 million. So that 1 million extra for some companies is material. They could have used it maybe to purchase other goods or even to increase their revenue. So it's kind of like a gap for all these companies, even though you would still use that withholding that have been deducted as credits later in the future. But some companies might tell you, oh, if I have this money, I could have used it to make more money. So it's really, really dicey in that scenario. But there are cases where, and there are situations where you can avoid all these things, right? So, for example, you can get direct procurement from the manufacturers, right? So the withholding tax acts as exempted manufacturers from withholding. So definition of manufacturers was also clearly stated in the Act, right? And then the Act has defined manufacturing or production as the assembly of a final product the making of a part or components using raw materials or other inputs, including labor and production head. So what this means is that if we are sourcing directly from the manufacturer, yeah, these guys are exempted from withholding taxes. So under production includes energy also too. So for energy, when I say energy, so it includes your electricity, it includes your gas, it includes your petroleum product also. You understand? So the policy is clear, right? The intention of the act is clear. Withholding on goods, good supply should target intermediaries, should target all these distributors, not the manufacturers, not the people creating the product who bears the full cost of the production, and then to think that all these guys really have like a low margin, and then you see a lot of people having so much withholding credit that they are unable to utilize. You find them in the manufacturing sector, because they have really low margin. So, and then the act has exempted them from withholding, which is really laudable, if you ask me. So it can also take the route of the small company. Small companies are also exempted from withholding taxes. So but again, like I said, you need to meet the conditions. The conditions is that you must have a valid payer ID, and then your transactions should not be more than 2 million naira in a particular month. There's also a case where there's a treaty rate agreement between a non-resident company and Nigeria. So you ensure that the reduced treaty rate is applied when deducting these taxes as source. And then not just that, again, you obtain certificate of residency from the treaty country before making payment. If you can't get certificate, get a document, that shows this particular non-resident company as is resident in this country where they have a treaty with Nigeria. So, and then again, there's also out-of-pocket expenses. So out-of-pocket expenses are exempt from withholding, right? But we should be able to separate our out-of-pocket expenses from our normal transactions where contracts are involved. So we really need to be careful when doing all these things. And then another interesting fact is that tax authorities can also disregard any of all these arrangements. If they find out that a particular transaction is lacking commercial substance, or they see that you are trying to gain a particular tax advantage, they can say they want to disallow it. So that's why it's really clear that when you are getting, you're having like maybe a out-of-pocket expenses, you're having and across the counter transactions, you clearly document all these things. You clearly state it there. You don't join your fees and reimbursables together. So let's take a look at the next slide where we have the contract. In this case, we have people who have different invoices. You can get an invoice where there's a gross-up amount. You can get an invoice where in the invoice it is silent. So you're confused. You don't know how to apply the withholding tax. You don't know on which amount to apply the withholding tax rates. The first option is the gross basis. So the payer, this is actually the right way to withhold taxes. So the withholding rate is charged on the gross amount. As the agent, you withhold and you remit. There is no CIT disallow, able, you get the beneficiary also gets the full credit, and that is case settled. The second option is net of taxes. You get a contract, maybe you have a contract with someone, and the supplier told you, oh, the money you are paying me should be net of all taxes. What this means is that you as a payer, it means that you want to bear the tax elements of all these things. So it means that the withholding tax you should have ordinarily deducted from the transaction of this supplier. The supplier should have borne that tax. Now you are paying the tax of another person. This tax that you have borne for another person will not be allowable for CIT deduction. When you are trying to compute your company income tax, this will be disallowed for company income tax, and it's a permanent cost to you. I classify it as a high risk area, and then the last option is the case where in the contract it was silent. It didn't state whether it's net of taxes, it didn't state anything. So basically what you should also do is deduct withholding on the gross amount, and then in the case where there might be a disagreement, it is clear to have like a proper agreement with the supplier, before anything is being done. So basically, the risk for net of taxes is that when you bear the cost of these taxes, it won't be allowed for CIT deductions, and then you bear that cost, you bear the full cost of the withholding taxes that ordinarily should have been borne by another taxpayer. So let's take a look at withholding and estates, trust and settlement. So this is also tricky too, because people have asked do these people qualify as withholding agents? Are they supposed to withhold on their transactions? Are they also supposed to be withholding agents? So like I said, the law is clear. When we were talking about the categories of who should withhold, right? We had mentioned a corporate body. We mentioned unincorporated body. We mentioned companies other than including those that are tax exempt. When we mentioned all these things, right? Trust also falls under these guys. So although the treatment will differ depending on the direction of the payment, and the nature of the beneficiary, but if you are a trust estate, you are also classified as a withholding agent. So when an estate trust makes a payment, if you are then made payment on an eligible transaction, you are expected to withhold. So in practice, what this means is that if you are as a trust, if you pay, let's say, professional fee, if you pay professional fee or even legal fee, you would have even paid your accountants to manage the estate, or maybe contractors to maintain your property, right? They are expected to withhold on all these transactions, right? And then the same goes too for them as residents too. So if you are also a resident too, and they do transactions with you, they are also expected to withhold from your own transaction. You get? And then the law spoke about no look through. So this is when a person is making payment to a trust. So the act has stated clearly that the payer does not look through. The payment is subject to the non-corporate withholding rate. So what this means is that, so as a withholding agent, right, you want to make payments to a trust, and then you are thinking of the withholding rates to use, So the law says it shall not be looked through. So what this means is that you withhold based on the corporate beneficiary, you withhold based on non-corporate rates, not the beneficiary of the trust. You don't go through the beneficiary of that particular trust. You are dealing with the trust, and the non-corporate rates should apply. There's also exemptions for these guys, especially guys in the real estate investment trust, right? The law provides an exemption for them, so any distribution or dividend payment to a real estate investment trust or a real estate investment company, they are exempted from withholding at source. So what this means is that if as a withholding agent, you are a withholding agent, and you are distributing dividend to these guys, these guys in real estate investment trust. So you should pay them their gross amount. You should not withhold from their money, They get you, and that's it. So let's look at the withholding and the CIT interaction. How do they relate? How do this withholding tax relate with CIT? How credit reduces final tax? So these are the credit mechanics. All right. So the first one, I think we explained this earlier. So the first one is withhold taxes. When you withhold taxes at source, the second step is to credit the beneficiaries. The beneficiaries claim these credits against their tax assessments, and then if there's any unutilized withholding credits, they can roll it over to the next year. So it doesn't necessarily mean that all the withholding taxes that they've deducted from my money this year has to be utilized this year. You can, after you've used it to offset your liability, if there's any outstanding withholding that you've not utilized, you can always carry it over to the next year. And then we have the net of tax model, right? So an example is if the rent is supposed to be 10 million, the landlord has told you, pay net of the amount, net of all taxes. Ordinarily you want to gross up, to get what the actual withholding should be. So the example is stated here. So if you gross up 10 million, right, it will give you 11.1 million. And then you charge 10% withholding on that amount, that's 1.1 million. So what the law says is that this 1.1 million will be disallowed for CIT purpose, because ordinarily the beneficiary shall have borne that tax, but now you are bearing the tax on another person. So again, what this means is that your CIT computation now, it should have an effect on your adjusted profits, and then if you are calculating CIT at 30%, what this means is that you already have a loss tax deduction of already like 333,000 naira. So these are one of the issues of net taxes. So let's go to the next slide. So before we go to the end of this section, let's go through a pre-payment run checklist. All right, so the checklist that everybody should look out for, try where you want to withhold. First off, confirm that does this supplier have a valid tax ID? Do you have a valid payer ID? I mean, you can always check online, so you can check on the NRS portal to confirm that the payer ID of a particular company is valid. In the cases where the payer ID is not valid or they don't have payer ID, you already know you double the rate of the withholding. What the actual rate should have been, you double that withholding tax rate. And then you confirm again. Second step is you confirm, is this withholding rate on the first schedule? Compare it. So if it's not on if your ERP system is not updated, you look at the withholding schedule, confirm the rate, and compare it with what should have been. And then you can ask yourself, is this transaction type classified? Have I not misclassified professional services as other services? Or have I not misclassified other construction as construction services? And then you check the deadline for the remittance. Ensure that when you deduct, you also remit before the deadlines. And don't forget that different state authorities, different tax authorities have different deadline dates for all these taxes. And then the last one is, you issue the withholding receipt to the beneficiaries. It's their right. You've deducted from their money. You should also issue receipts to this beneficiary. So before we close, let's see one last case study. So in this case, right, it's assumed that Tech Solutions Limited, which is a resident company in Nigeria, engages Global Consult, which is a non-resident company, for management consulting. Right. So the contract agreement is 50 million naira, and then the invoice is silent on withholding. So again, most of all these non-resident companies are usually silent on withholding. So the first right step to take. So the first step is the classification, right? So in this case, they are non-resident companies, so they don't have a PI ID, especially when they don't have PI ID. So real estate is classification. Management fee to non-resident company is 10%, and then you already know that will be the final tax, right? So you deduct that 10% for 50 million and and then of course, that you have to remit before 21st of the following month. You remit to NRS, and then the fourth step is you document these things, issue a receipt to Global Consult, and then the last step is Global Consult takes that as the final tax, especially when they don't have a physical presence in Nigeria. So that will be their final tax for them. So the alternative thing you can do, maybe alternative way you can do this transaction is net of tax. So in this case, where the non-resident has told you, oh, this 50 million is net of tax, right? Just like we illustrated with the rent, what this means is that you gross up first, so when you gross up first, you now pay 10% of that amount, which is supposed to be the final tax, right? But don't forget again that if you bought the tax of another payer, that particular expense will not be allowed for CIT deductions. So if you have it in your account, it will be disallowed for tax computation. Right. So the businesses that get withholding rights under this new act are not just the ones with the biggest systems. They are the ones who adjust to the rules, they update their ERP systems, and then they are really compliant. So David, over to you, please.
Thank you very much once again, Yanu. I mean, it's been an interesting ride as you've taken us through the compliance roadmap under the new architecture of the withholding. And I mean, you've built our knowledge brick by brick on these three pillars that you have covered. And so we have been collecting questions, like I earlier mentioned at the start of the webinar, throughout the session. And to save our time, a couple of them have been answered already. However, I would be reading out the ones that are yet to be answered. So there's a question here, and Ian, this question is for you. There's a question from Timothy that says, how does withholding apply to payments to foreign consultants under NTA 2025? And where do double taxation treaties change the answer? So I'll read the question again. How does withholding apply to payments to foreign consultants under the NTA 2025? And where do double taxation treaties change the answer?
Interesting question. So, so in this case, right, payment to non-resident company, right? So when there's payment to non-resident company, right, withholding tax should be double of what the actual rate should be. It can be maybe for professional services. If professional services is 5% for residents, so for non-residents, that it's double the withholding rate, which is 10%. And then in the case where the non-resident is resident of a company where they have a double treaty with Nigeria, then it means the rate would reduce. So you use the reduced rate to calculate your withholding.
Thank you, Ianu, for that answer. So we have another question that says, we hold withholding credit notes that we have been unable to utilize for over 2 years. What are options under the new act? So the question again, we hold withholding credit notes that we have been unable to utilize for over 2 years. What are our options under the new act? I know this question is for you as well.
So David, for unutilized credit notes, I explained earlier. So if you have unutilized credit notes, you can roll it over, right? You can roll over to future years. It is really non-exhaustive, right? So for withholding, when you have unutilized withholding, so you have two options, right? So the first option is to roll over, to carry over to the next period, where you have your future CIT. You can use it to offset your future CIT, or you request for a refund, right? You can also request for a refund from the tax authority. So I mean, you need to do this in writing. You need to apply for all these things, especially when you know that this amount is really significant, and then when you know that you have a low profit margin, then withholding that you have, it's so much more than what your future liability can be. So you can request for a refund or roll it over to future periods.
All right, thank you, Yanu. So there's a question that is kind of a build-up to the one you just answered, and I'll be inviting Mr. David to answer that. So the question says, can withholding on used credit be used for subsequent taxes under personal income tax? Can withholding on used credits be used for subsequent taxes under personal income tax?
So just to really answer that, the first thing is we need to understand that withholding tax is not a different type of tax in itself. It is simply an advance payment of the underlying tax. And so, of course, if you have a deduction that was made for income tax, you can use that deducted credit applied against your subsequent personal income tax liability with the tax authorities. So that is what the tax law actually provides. However, if you're trying to request for a refund, you have a 6-year window, to request for a refund. But yes, you can use the deductions made, on for or against your income to offset your personal income tax liability at any point in time. Thank you.
All right, thank you so much for that insight. So we could keep going, but I would like that we respect each other's time. And so just before we close out, our managing partner has 3 points to learn before we close. So Mr. Paflo, over to you.
Thank you, Yanu, and thank you, David. I'll just quickly close off with 3 things, and we can all get back to our busy days. The first thing is that, with the Nigerian Tax Act 2025 or withholding tax, it's not really about rates. Yes, rates have changed, but more importantly, the architecture, right, the automation. And so your team needs to take a structured review to look at how the act affects your systems. And you need to do that immediately. Don't wait for next week. Don't wait for next quarter. Do that now. Secondly, is that the most expensive errors we're seeing are not really about applying wrong rates. It's about not capturing new transactions that the Nigerian Tax Act already has brought into scope, right? So as you're doing the analysis, as I mentioned earlier, you need to now start asking yourself, what so much arguments is now there, it's totally eliminated. And as much as the withholding tax regulations specify that individuals are exempt, if you're a sole proprietor trading under an enterprise, the regulation is clear about the fact that enterprises are covered within the remit. So, of course, you still have to withhold unless you fall under the small business category. And Rihanna has done a good job on telling us about net of tax contracts, the fact that if you sign a contract that is clear about the terms being net of tax, you then mean that you're bearing the tax of the counterparty that you're dealing with, and that particular position might leave you exposed on the extra tax that you're paying. So, of course, it makes sense for you to use gross-up clauses in your contracts. And third, if this session has left you with 2-3 areas that you're not really certain about your position, I'm seeing a lot of questions, please feel free to send us an email, tax@shelze.com.ng, or you can browse through our website. We have a number of resources on there. We're going to be posting videos, a lot of articles and write-ups that you can actually learn from. And that's really what we as Shelze Professional Services and the Shelze Fiscal team exist. Was led by Ian, and for those who have attended our previous series would have seen him prior to now. He handled our webinar on VAT input claims, but today is Ian's final webinar with Shelze as he moves on to the next chapter in his career, and I just want to thank him properly and also make this appreciation publicly for the standard of work that he has delivered to our clients and to this audience. We're proud of the work Ian has done, and as I always say, door is open. Let's keep in touch. And finally, this is our fourth in the series. We are going to be having the fifth one next month, which is around small businesses. David will give us more detail on that, and you will also get follow-up emails. I know that some of our emails haven't come through. We had a few technical issues. We should resolve that this week and get webinar 2, webinar 3, and webinar 4. So it's going to be a jumbo pack towards the end of the week into the weekend. Thank you so much. Over to you, David.
Thank you, sir. And Ianu, from all of us, congratulations and thank you. And to our attendees, as Mr. Paflo has rightly said, the recording and the withholding quick reference card would reach your inbox with the email we used to register for this webinar within 24 hours. And the details of our next webinar would also be included in that email with the link to register. So if you still have any questions regarding what was communicated today, you could also send us an email at tax@shelze.com.ng, tax@shelze.com.ng, and be assured that we'll respond to every message. On behalf of Shelze Professional Services, thank you once again for joining the Shelze Fiscal webinar series. Have a productive Tuesday and see you in the next one.
Thank you, everyone. Have a great day.
You, everybody.
All right, thank you. Thank you, guys.